Hi everyone, this is Anton Madley with Peak Market Watch, and today my colleague Camille T is joining me. Hello, Camille.
Hello, Anton. How are you today?
Good, great. So we wanted to discuss a little bit the Fed pivot, if you want to call it that way. That they had the meeting on December 12th and 13th. So now we have had a couple of days uh, uh, to look at what they're really meaning with it and how the market has been reacting. So I think it's a good time to talk about it before we end 2023 and then move into the new year. So why don't we have a quick look at what their projections are and how they have changed. So this is from their announcement from for December 2023, again from their meeting on December 12th and 13th. Uh, as always, they are in these meetings, they are projecting out what their changed view is or unchanged view of various core pieces in the economy. And naturally, GDP plays a key role there. And when we look at that, uh, in the September projection, they were slightly more positive for 2023, but in reality, it's essentially the same, right? When it comes to the unemployment rate, uh, it's essentially unchanged. So they are still very, very positive about being able to control unemployment. And then when it comes to inflation projection, obviously we have the PC and we have the core. Uh, there is not they've dialed it down a little bit, but in reality it is not really that substantial of a difference, particularly when we then look further out, all the way out into 2026. So I think what we solely can see here is that, uh, particularly because in 2023, inflation, the official calculated inflation, is certainly came in more muted than what they originally thought, and certainly what they thought back in September, which I believe is one of the reasons or the core reason why they are now in that in a more pivoting mood. Now, when it comes to the all important Fed rate, uh, and we look at where they were in September, uh, the guidance back then for 2024 was at 5.1, and as it has been well published over the last week, and through various announcements and press conferences, the view is by the end of 2024 that we are at 4.6. So roughly 0.5% lower than what they thought back in September. For then looking out towards the end of 2025, then they believe it can go down to 3.6 compared to 3.9. So they're the again a little bit less of a drop there in 2025, but still obviously a drop from where we were before. And then once we get out into 2026, they essentially feel that there is not really any change, and for even the longer run, that it's somewhere around the 2.5% range where they feel that it all can be dialed in. Uh, Now, uh, that is not necessarily what the market believes. So when we look at where this is from Chatham Financial, it's an easy chart that they are publishing. And when we look at it, it's interesting that we have that's where the Fed uh, dot plot is and where the median comes in. Obviously, roughly at that 4.6 by the end of 2024, and then roughly at that 3.6 in a year later. As we can see, what the market believes of the 1 month SOFR, which is the closest in the private market from on the boring side as an index, that the general view is that the rates will come down more than what the Fed is telling us. Now, is the market right or wrong? Who knows, right? The reality is the Fed very often misjudges where rates are going, and the market obviously misjudges where rates are going. So this is just where the market believes the rates are going to be, and we don't really know what's ultimately going to happen. That's a forward curve. That's market expectations. That's not what's necessarily going to happen. Now, when it comes to the 10-year, 5-year, and 7-year Treasury yield, and obviously the 10-year, particularly for permanent refinancing in the commercial real estate, is the all-important index. Sometimes, if you go shorter, you may have a 5 or 7 year Treasury yield as the index that is being used. But I think what is important here, obviously, the Fed, unless they start applying a yield curve control measure as Japan has been doing, the Treasury yield curve is driven by market and not by the Fed. So based on this, the view generally is that we, even by the end of 2024, the 10-year Treasury will be around 3.8. So will not be significantly lower than we are today. Now, there are some participants in the market that believe that we will be in the low threes or even in the twos, right? So some will that's where we will be at 3.8. Others believe that we'll be at 3, and these are all bond market experts. So even among bond market experts, there are varying degrees of opinions. But this is where the market overall believes where we are going to be. My view is that it's more likely that we will be in at that level, because at some point the inverted yield curve needs to resettle, and uh, we are essentially still inverted well into 2025. So the chances really that the 10-year Treasury, 5 and 7 year Treasury, that the yields really drop very significantly would also mean, obviously, that SOFR and the Fed rate would have to drop significantly, which, in my view, would mean that we have a significant uh, event, negative event, a massive recession, or a black swan event, or whatever it might be, right? So that's where we stand. Camille, do you have any comments to this?
So, well, the to your point on the Black Swan event, I mean the pandemic, the lower rates during the pandemic, well, it was exactly the case. So people tend to forget they want lower rates, but usually such low rates come for a bad reason. Now, my question to you is: can you give us some color on why, around why now, on the this interest rate decision before they actually achieve their goal, although they're close. But uh, can you give
Yeah,
us some color around that?
yeah. I think that's the the problem is when you measure month by month, right? It can be, let's say, a 0.1% increase of inflation, or it can be a zero point 0.2. If it's a zero point 0.1, you actually have reached the target. You actually below the yearly target. If it's a zero point 0.2, then you're still above the target. So there is really not that much of a uh, of changes that need to happen for technically to be above the target or be below the target. But I think when we look at the overall sentiment and where they believe in, because also inflation has cooled down stronger than what they originally anticipated for 2023, I think they are just more comfortable with having the inflation under control. And so rather than potentially still increasing, tightening the rate one more time and then keeping it at the level where we are today, I think they are much more comfortable now that they can lower the Fed rate by the levels what they are telling us now without increasing inflation. Right. So whether they are right, again, it's impossible really for anyone to judge. I would say if they drop the rate much more than what they have announced now, then we are likely just having another round of inflation that's going to hit us. And this is the reason why I'm not really that confident that what the market believes that the Fed will cut rates much more than what they already communicating here, where they believe that there will be by the end of 2024, except again, unless we have a major economic disruption. And as soon as you have that, then all bets are off anyhow.
And how quickly do you see the multifamily market reacting to that in terms of valuations?
Yeah, it's a good question. And it's really tough to answer, right? What we always need to recognize is that real estate is very slow moving, right? Stock markets, everyone is giddy about any pivoting message that is being communicated out there, and everyone is rushing in. Stock market can go up in at an instant, and it can drop at an instant. Real estate, obviously single families too, but certainly also on the commercial real estate side, it's a very slow moving vessel. It's like a major tanker in the ocean. Even though the signal may have been changed, it takes time for prices to adjust and activity to adjust, right? And I would say we can make that argument also with rates having moved up so much. Rates have moved up, but one certainly can make an argument that even though prices have come down on the multifamily side, depending on the markets, by 20 from the peak by 20% or more in some markets, one still can make an argument that the prices haven't really adjusted to the interest rate environment, meaning that cap rates have not widened as much as they should have in comparison to interest rates, right? So my, my view is cap rates have not really moved as much. And now, if the Fed is going to pivot, now everyone thinks, oh, now cap rates will immediately drop. Well, my view is it's not necessarily the case uh, because ultimately, again, it's that slow moving tanker that the reaction has not really been fully completed for the interest rate rises. And so we cannot just expect that now just because interest rates potentially move in the other direction on the short end. And then also the treasury yields come down significantly. That suddenly cap rates will contract very quickly, right? Uh, and ultimately, it's all about what investors need in terms of yield and how much money is being allocated on the lending side as well as equity side for a particular asset class.
Sure. So, my next question to you was on the institutional side. So, where do you think the interest rate needs to get to for the institutional capital to be more involved? I was initially asking when to get back into play, but it is there. So, when do you see it being more into play?
Yeah. I think institutionals, they're always there to deploy, right? And obviously, it's always hard to know how much so-called dry powder is out there. There is certainly plenty of liquidity that has already been reserved for commercial real estate, including multifamily. So it's not that that money cannot be deployed. However, particularly institutional money is they are not just deploying it just because they have to. At some point, they may have a challenge when they have a fund that is sitting on a significant amount of money, but at some point they still need to decide whether they really want to go into a lower yielding, meaning a yield that is below their target yield of their fund, or just sit on the sidelines. And I think right now, the overall view still is with a lot of institutionals that they should be able to get better yield by waiting. And we will see how it's going to happen, what's going to happen in 2024. Uh, and that might open some more money coming into the marketplace from the institutional side. But again, I would say I would warn there from with there are a lot of people out there believing, well, now interest rates drop and cap rates drop immediately. Again, because cap rates haven't really adjusted sufficiently, that also from an institutional perspective, they may say, well, sorry, guys, just because interest rates drop, we are not going to adapt our cap rate expectations, right? Um, so, in other words, I think there is still a need for sellers to be more realistic with their pricing expectations. So I see it less on the interest rate side, but more on the seller side that they have been not adapting fast enough to the new market environment, and the buyers are out there. That's it's not a question, but the sellers need to adjust.
On the on a slightly different note, there is the rate caps. Maturing loans within the next 1 to 2 years have especially in the bridge loans on the bridge loan side have the ones who have rate caps also have an extension for rate caps to deal with, and these got very expensive. Um, can you can you talk to us a bit about that, where what the situation is now?
Yeah, good point. I think we have also uh, the site here with Chatham Financial. For any one of you who has a rate cap or needs to repurchase a rate cap, this calculator on Chatham Financial's website is easy to use. Obviously, it's not a, a, a current pricing that is completely accurate, but it gives at least gives you a guidance where the pricing roughly is going to be. Uh, Now, this is for a $10 million notional amount. Once you go below 10 million, it gets a little bit more expensive comparatively. So obviously, the larger the notional, the better the pricing is going to be. But overall, it's just to show the overall picture of where we stand. I think this is a good chart here. So now let's just think of why do we have a 2% here, or we also can use a 2.5, which shows up here. Why do we show this? A lot of these deals were done with a 2% or a 2.5% strike rate back in 2021. Obviously, these loans are now coming due, or they need an extension, right? So either you refinance, you sell the property, you refinance the property, or you need to extend the bridge loan. If you extend the bridge loan, then you, in most instances, you need to buy an interest rate cap. a replacement interest rate cap because your interest rate cap is now expiring at the end of the initial loan term of that bridge. In some instances, we have been able to negotiate with lenders that there was no need for an interest rate cap, but that rather the money has been put into an escrow. Uh, but whether it's being put into an escrow for debt service for the next year or whether it's an interest rate cap, the reality is money still needs to be raised by a deal sponsor to have that protection in place for the next year, right? So when we look at that, where we were in 2021, and we have a $10 million loan, and we want to extend that out for 2% for another year, we talk about roughly 300,000, right? Uh, Obviously, everyone is screaming, "Oh, this is very expensive." The pricing has come down. Thanks to interest rates coming down, or at least the pivoting, and the market opinion is that rates are coming down. Because remember, that's the market, free market, that ultimately prices this. So there is a counterparty that takes that risk. And uh, so let's assume that short-term interest rates will drop for another 50 basis points or so. You could imply that you may have a drop now for here for maybe uh, 20% or so. And if it's a 1% drop in interest rates, you may get roughly a third of a drop, right, in your cost. Now, just we just have to be realistic here that we just do not know how the market ultimately is reacting. If we have a very significant drop in interest rates, whether the market is tightening up, because everyone thinks, well, if you have lower interest rates, then also buying rate caps will be cheaper. That is correct as long as it's a orderly fashion of a rate drop. So as long as we go through as of what the Fed is projecting, let's say have a roughly half to three quarters of a percentage drop over the next 12 months, then you definitely see lower costs. But if it's only a black swan event, major recession, uh, market participants in that segment will also be uh, less, which means that whoever is still willing to do these interest rate caps and other derivatives, because the market is shrinking, the pricing is not necessarily proportionally adjusting to the rate drops. Uh, so that is a challenge we always seeing in our discussions with our clients, because they just see, well, interest rates come down, so now our pricing will be better, right? And what I would always tell them, look back to other periods in the past in commercial real estate lending, when the market was in distress, interest rates came down. Yes, that was true from a treasury and Fed rate perspective, but your borrowing cost was not necessarily coming down, right? And why is that? Because once you have significant stress in the marketplace, you have much less liquidity, and you have fewer market players, and the market players, market participants that are still out there, then they will price it much higher. So in other words, the credit spread is will be much wider, which means that even if a 10-year treasury yield, let's say, drops for whatever reason to 3%, you may not be able to borrow at, let's say, 150 basis points above that, but maybe at 250 basis points above that. So you not necessarily get advantage of the treasury yields coming down and short-term rates coming down because of the credit markets, or tightening, or they may shut down completely, right? Which is a worst case scenario, which we certainly have seen during certain periods, including the GFC. Uh, and this is, I think, a very important message. I always say, be careful of what you're wishing for, right? There are a lot of particularly newer indicators out there hoping, oh, interest rates, hopefully interest rates drop by 2%. If they drop by 2%, we will have stress in the system, and you may be lucky that you actually can borrow at that point.
Thank you.
Yeah. Uh, do you have any other comment?
Comment or question? Since you mentioned the GFC, like, can you point on the similarities you see with the GFC?
Well, there are, I would say the similarity is back in doing GFC. Obviously, everything was residential driven, right? So there was that craziness in the residential market to a large extent by easy financing. I would say this time around, the residential market is completely different. We have a massive amount of mortgages that are below 4%. Many are in less than 3%, but only a majority is below 4%. And it's not speculators that are the majority of these uh, residential homes, or individually owned for their own residence. They have low mortgage rates. They are not moving anywhere. So that's why obviously we have that shortage of inventory, and that's why prices continue to stay high. Uh, Completely different from where we were doing the GFC. Now, I would say we have more of an element of a GFC environment that we solely have pre-GFC environment that we have seen in the commercial real estate side, specifically multifamily in 2021 and to the mid 2022, because that's where all that cheap financing and crazy financing came into play, and that's why prices moved up like crazy, right? Obviously, we it's not everywhere, but we only can talk about the Sunbelt markets, where in some markets prices just exploded in 2021 to mid 2022, and that was all driven by record liquidity that came into the market, but also extremely cheap financing, right? And how was that financing achieved? Similar to the GFC for residential, all short-term financing, bridge financing with floating rate loans. And so now we obviously have a situation where all these loans are that are the high leverage ones, and they are not all of them, right? But it's only everyone who took out the maximum leverage that they could get at 80%, very often adding pref equity on top of it. They have a problem. And why did they do that? Even for stabilized properties, because if you took out a Fannie or a Freddie loan, you may have gone back then a 50% leverage, and with a bridge loan, you were able to get 80%, right? I would say there are similarities there to GFC for all these investors in single family homes back then that went with these crazy adjustable loans. And we saw obviously exactly the same in 2021 and to mid 2022 on the multifamily side with all these bridge loans. And to be fair, a lot of new market participants, a lot of new syndicators that came into play here that have have not a long term experience in that segment, and it was essentially that gold rush mentality, right? The FOMO mentality was just insane, and as you know, right, in some markets, values increased massively, right? And they already have come down, but I do not believe that they have come down sufficiently.
So they pay more to win the deal. They end up with a high leverage, high cost basis, too high cost basis.
That's what it is, right? So if you buy a property that is more or less stabilized, obviously everyone came up with an argument, oh, it's value add, right? But sorry, but if you spend $5,000 to improve per unit, that's not a significant value add to really justify a high leverage bridge loan and add pref equity on top of it. But that's what was done. The problem is with that is that everyone was very aggressive with the rent growth during that time because we had record rent growth, but they were projecting it out. And I'm not just talking about sponsors; it was also uh, lenders that did exactly the same thing, right? So it was really very much lender supported craziness that was out there in a lot of instances, and also underwriting to an exit refinancing at around 4%, right? And all that combined makes it virtually impossible unless the treasury yield drops significantly or the SOFR drops very significantly, that there is really a way out over the next year with many of these loans, right? And again, it's important to highlight it's not all of them, but I would say, in my view, is it's at minimum half. I would say it's probably 70% of all these bridge loans that have taken out with these maximum leverage that have that problem and they didn't stress test to be able to refinance at, let's say, 5.5 or 6% interest rate. Right?
Okay, wonderful.
Yeah, very good. So hopefully it was helpful for you guys out there. If you have any questions, reach
I think it shows here.
an exciting